Hey guys, what's going on? Kunal here, Bulls on Wall Street. Guys, I want to talk to you guys. Man, it's been such a wild market, and I know a lot of you guys are probably like, whoa, what is going on in here? And a lot of times we think, it's really hard to trade in this kind of market, and it is. This is not an easy market for even professional traders, and for new traders, it can be downright overwhelming. In the end, the patterns all work. Everything is really the same, but there's so much more range and speed that you have to be more precise. You have to be an expert in precision and entries. And when you're new, that's like usually, right, those are the things that need to be fine-tuned. But there is a couple patterns that I'm seeing quite a lot in this market that I think you guys definitely need to learn, and that you guys can start to pull off without having to do too much crazy analysis. It's not an easy trade, as there's no such thing as an easy trade, but I do think that the mechanics of this type of pattern are fairly simple, and with a little bit of legwork and some discipline and just a lot of practice, I think you can get this down. So this is a trade that we took in our chat room in yesterday, actually. And it ended up being an amazing trade. Now I left like a whole crap load on the table here, but we took in our, I trade in front of our students every day on screen sharing video. We have a Discord room. You guys are more than welcome to join us in there. It's the hot spot. Like it's pretty fun. We got a great group of guys in there. And, we took a short in dust at 16 yesterday. This thing hit. Now, granted, I didn't hold it this whole way, right? But I think this thing hit 16 for what we call a rubber band short. You're seeing both types of plays in this market, rubber band longs and rubber band shorts. So essentially what a rubber band long is, if you think about the parameters, a rubber band long is the opposite of the short, but a rubber band short, which is what we did here. So I shorted this thing right at 16, so not the top, but fairly close. And you can see like this big just kind of tank over here. So a rubber band short has a few different parameters to it, something that they all need to have. So there's a couple things that I must see in a rubber band short. So number one, like these are daily charts over here, all right? A rubber band short must be an extended stock, or what you'd call parabolic, that is up over a period of 3 days or more. So I find that they're usually like 3 to 5 days. If it's anything longer than that, it just becomes a trend. And so that becomes like nearly, impossible to come in. We're looking for like something that's just exploded like hundreds of % in a few days. And then we're looking to kind of take it down. Now, you guys know I'm a trend trader. I don't like actually going counter trend unless this particular trade sets up. And I still don't like going counter trend, but I'll do it in this particular setup because the reward is so great compared to the risk, meaning that I could take, $10 and dollars of reward for risking much less. And so I think that's something that even if it's counter trend, because it's so extended, it can do. So I'm looking for an extended parabolic stock that is up over a period of a handful of days. I need to see the stochastics over 90 ideally on this type of play. So I want to see stochastics. I use a stochastics indicator, and I want to see it over 90. Stock must be completely outside its upper Bollinger Band. So if you can see here, like I use on my daily charts, I have these averages, and I use these Bollinger Bands. So when you get like a stock that's completely, like when it opens, it's completely outside the upper Bollinger Band, what it's telling you is it's so extended at that point that it's like a rubber band. It's going to snap back, right? You ever pull a rubber band so hard, what happens? Snaps right back. So I'm looking for these type of, I'm looking for this, and there's, of course, a handful of other small little caveats that you would do depending on the type of stock, small cap, large cap. This is an ETF, so it's not a small cap or a large cap, it's an ETF. But, if it was a large cap stock, you would change around the parameters slightly, and small cap stock also slightly, always adjustment. So this is the rules of what you do to find these. Now, I usually only take this trade if I get an exhaustion gap. So an exhaustion gap is when you're already extended. See how this went from 460 to 15? So it's already up like 300%. When it gaps up again, well, that's called an exhaustion gap. So what happens is, that's what we call in our chat room a sucker's gap. It gaps up, and most of the time when stocks gap up, right, people are trying to take out the opening range. No, that's a sucker's gap. A rookie or somebody who's not thought about their plan fully would try to do an opening range breakout or ORB on this. That's natural. I used to do it all the time. You only do opening range breakouts when the daily chart tells you that you want to do an opening range breakout. The daily chart, what's over here, tells you exactly the thesis of your trade, like what you're trying to accomplish. And then it's your intraday chart that is used to define entries, exits, manage risk. So like as the stock gapped up, as soon as it broke under the 9 EMA, so that's its first level of support, I take this thing short. And I'm just going to use a stop, you know, like a 50-cent stop on something like this. I'm going to give about half candle's worth of room. The reason is that it should work right away. There's no wishy-washy in this, like where it's like, okay, I'm going to scale in and do this and that. This thing's got to work right away. So I pound this thing, you know, right around 16 average, and it's game on. I use a 50-cent risk, and then it's game on. So my first target is, you know, down into these EMAs here for like $1 something. Then I'm hoping for a red roll, and then, you know, I want to keep going. So, you know, I ended up getting out of this trade. So we had some good covers on this trade. You know, I ended up covering some at 13.10. I covered it all the way down. And then, you know, we kind of flipped it at one point with the opposite ETF2, which was pretty cool. So I ended up actually covering, you know, I covered down into the 11s over here, and it ended up being a good trade. And, you know, granted, you could think like, okay, well, it went down into 5 by the end of the day. So I left a lot on the table. But for this particular setup, like the opening range, like you want to really get out of it by the first hour. Now, where I made my mistake, and this was a grave mistake, because like, if you look at a trade, first of all, getting out in the 11s, my last shares, like, you know, getting out here and in the 13s and 11s, that's like good scaling out, smart scaling out. Should I, could I, you can always do a coulda, shoulda, woulda. I should have just held it all the way down, but I just don't trade like that. You know, I follow my rules. Where I made my key mistake on this was, you know, as it popped into these EMAs here, you know, I should have taken some scalping shares and, you know, maybe took like 1,000 or something here with, you know, 20, 30-cent risk. You know, I would have got like a nice $2, $3 again. You know, it doesn't look like much, but like from here to here, $3. And you can see here, like you got a little bear flag, you know, even from here down to here, $1.50. And then down over here, like it broke under 9 and it dropped to 5. I mean, that's $4 right there. That's inexcusable. I got caught up in other stuff. And so like I had a good trade, but man, like, you know, if you have this breakdown here, see how the 9 EMA is coming right on top of it? You know, you get short at 875, put a stop at like $9, risk 25 cents. You could get 2,000 shares, risk $500. I mean, you could have made, right, thousands of dollars if done properly with minimal risk. So I think I had a great idea, but I need to be more aggressive and really just pound on it. If you get a hot trade, something that trends, you only get a handful of those a week. So we have a responsibility to pound it. You know what I mean? To keep pounding it and throttling it while the trend is there, because you only get so many of them in a week. If you think about it like this, so like for a lot of you guys, you trade smaller accounts, right? If you have, say, 200 shares, it costs you $3,000. Man, if you can get this thing down into, you know, trade it back and forth and down into the 5s, I mean, right? You could make a couple $1,000s by the end of the day just trading it back and forth. You know, you take your shred, re-enter, take your shred, re-enter, and you may be able to, you know, with the application of a little bit of margin, you know, be able to really kind of build out your account. There are trades that are just called account builders. Account builders are trades that are low risk, high probability, where you get intense range. And that's how you build your accounts. You know, I always teach my students, like, hey, we want to grow our accounts like $100, $200 at a time, but we are always on the hunt for account builders. those setups that can give us asymmetric reward to risk scenarios to get this thing going. So now on the other side, so this is not a one-trick pony. On the other side, the opposite of dust is called Nugget. Nugget is a stock that was at $42 and got all the way to $5 in just a handful of days. So in terms of our rubber band setup, the rubber band short, if you just take all of these and turn them upside down, you would have a rubber band long. So you would want stochastics under 10, okay? And then you're looking for the same type of thing. So we also took this trade in the chat room. It ended up being really good. It was a quick one for me. I should have held it longer. I made a mistake. I longed at 705, sold half at 754, so I took a little bit, sold a quarter at 802, and then I sold the rest at 830. It ended up being a pretty good gain because it was only from 1021 to 1044. I mean, if you think if you go from 7 to 830, it's like a 10% plus move in 20 minutes. It's great, but I made another mistake of like not pressing it later. So you can see this stock has been going down, 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 and you got an exhaustion. These are gold ETFs, so you get an exhaustion here. That exhaustion is the sucker's gap. You don't want to short it. You want to look for the reversal. So as this thing started to go, the first entry actually would have been at 6. This would have been a better entry. I waited till 7 because I was waiting for it to break over the 20 EMA because I thought that was going to be a lid on it, as it's been, you know, that's been an interesting spot, and I had a range break right here. So I hit this thing right at 7. I put my stop right over here. So I was risking, you know, 20 cents, give or take. I usually just put it right under the candle for that particular play. And I was out into this thrust. Now, I did the same thing with dust. Where did I make my mistake? I should have been hitting this first dip and then, you know, adding into the breakouts. And right, I had other opportunities to get into this. You can see this end of day play over here. I mean, that gave 9.70 to 11, $1.50. And it's so clean. Look at something like this, right? You have 10, 15 cent risk on it. So you can go in thousands of shares, have like $300 risk, and you can really catch a nice rip. So great idea. I still did some good cheddars on those 2 trades, but it could have been like one of those type of trades, the combo of these, because they're both gold ETFs. The combo of these, it could have made my month. You know, if you think about it, like, you know, like a $16 stock, I usually would like to short like 2,000 shares, you know, maybe a little bit more depending on the risk. This one, my risk was like 50 cents, so I was only in like 1,800 shares. You know, you write this thing down, I mean, you're making a lot of money. Now, Grant, I did okay, but I missed this whole, if you're trading a couple thousand shares back and forth and you missed the other $5 to $8, you left a lot of money on the table. So great entry, great idea. I would even say, you know, the execution was good on the trades I took, but I give myself, you know, negative for not pushing the chips in when I saw the opportunity. I need to be doing that, especially in this type of market. And I think I ended up at $4 today. I was like, when I said $4 today, I was like, wow. Hopefully that helps. I'm going to be doing a webinar on how we're trading this market. I believe it'll be on Sunday or Monday. I'll make sure to send everybody links out. And as always, if you like these videos, let me know. You can email me, kunal@bullson.ws, or you can hit me up in our Discord room. You know, I'm always in here chit-chatting. And, you know, we make guys check always on the website and stuff too. You know, make a lesson of the day like this every single day. So, you know, you guys have like hundreds of lessons and videos to go through. Take care.